the book, you talk a little bit about these windfall gains and how investors are able to observe and understand and internalize the idea of the fact that falling bond yields were responsible for a large part of the rise in global bond portfolios over this period. But somehow they're not able to connect the same dots for equity valuations. But in fact, equities and bonds were both impacted by this discount rate effect, which provided a very substantial tailwind, not just, of course, over the past decade, but over the last 30 to 40 years. So how, I mean, and you mentioned this, right, going from sort of a lower cape to, or a high cape to an even higher cape over the last decade, which implies going from a low earnings yield to an even lower earnings yield, right? So what does that imply, do you think, for U.S. equities and perhaps for global equities over the next 10 to 20 years?
Yeah. I think so. I do have an advantage in being an old bond guy because in bond markets, it is so obvious that when yields are falling, the prospect for the future, you should be looking at those starting yields. And for the past, those falling yields probably meant that you got some, what I call windfall gains, or the discount rate effect. Basically, you earned more than you were expecting because of this sort of unexpected yield decline. And something similar happens for equities, actually for our various illiquid assets as well, real estate, etc. And that has influenced all these other asset classes. It's just not so transparent when the yield isn't staring you at the face. And there are some other moving parts in the pricing, but it really would serve well any equity and illiquid investor to think of the same logic. And that logic then says that when you interpret past returns, you sort of try to adjust for the windfall gains that you got from some within sample repricing. Also, Cliff has written nicely about it last year in a blog. So I think that helps you somewhat immunize against what I call rear view mirror expectations and the complacency that you get from those high returns. And specifically now on equities, you are asking. So equities are even more long-lived asset than bonds. So there are different ways of measuring duration. So for bonds, duration is average cash flow length or sensitivity to your own discount rate. For equities, sometimes people talk of equity duration as sensitivity to bond yields, but that confuses things, I think, with the stock bond correlation. It's better to talk about equity duration in terms of sensitivity to its own discount rate. And when I estimate that, I get something like, let's say, duration of 15, which is more than for most bonds. So any 1% move in equity discount rate gives 15% repricing of equities. And there are, by the way, like other models where, like some simple models where you would assume that cash flows are totally constant, you would get even bigger numbers, 30, 40, 50 year type of duration for equities. Anyway, so equities, really long duration, and that means that they have benefited a lot. Actually, like I calculate in recent decades, there's been maybe 3% type of annual repricing of equities. Even over the last 100 years, more than 100 basis points of average returns has come from repricing. Anyway, so that's something to look back, and going ahead, it again, I think makes me more cautious, even assuming that yields are where they are. If one thinks that there would be some correction towards higher yields, that's a really scary scenario.